So that's politics, and we'll, of course, hear a lot more of that as we head into elections. Let's focus on markets right now. Sashi Krishnan is Chief Investment Officer at Birla Sun Life Insurance. He's with me here in our studios in Mumbai. Sir, thanks very much. Good morning. Great to have you back here on the show. What's your sense on the market now, sir? The market seems to have survived emerging market currency scare, some geopolitical tensions, which came on very strongly, and they've kind of ebbed also equally fast. Where does that leave us?
See, I think the market seems to be reacting at this point of time to the macros and the emerging situation in the globe. And I think as we move into the poll phase, and as you rightly mentioned, it's a fairly long poll phase, April through May. Obviously, it's going to be that much more difficult to focus on bottom-up stock picking because the markets are going to be driven by macros. Specifically, if you look at India, you will see that we did have a phase where macros were not doing too well. In fact, if you look at growth, for example, GDP growth at less than 5%, I think since the mid-80s, we haven't had a less than 5% growth. So we actually are in a very, very tough position. We had issues on inflation, fiscal deficit, current account deficit. If you look at the global situation, I think emerging markets have gone through a lot of problems. I mean, Ukraine being only the latest of the lot, but you had currency devaluation across nearly all markets, Chile, Argentina, Brazil, South Africa, name it, and all these countries went through, fairly, tough situations. Most of them reacted, some of them tightened interest rates, many of them, like China, tightened fiscal policy, many people went in for devaluation. But I think India has been, fairly steadfast in as much as, the approach that we've had has been very, very sort of consistent. We've been targeting inflation. We've kept the rupee steady. And I think this has held us to stead. And, if you look at FII flows into emerging markets on a year-to-date basis, we are still positive. Maybe, 500 million, but we are still positive compared to, most other markets which have seen huge monies getting out. So I think, while the macros are going to be important, I think, India has sort of overcome a lot of problems that, most similar markets faced.
Yeah. And we've discussed this before, is elections are going to be focus, right? People now expectations are pretty large in terms of say Mr. Modi, for example, and how he can fix the economy and many of the economic problems that the country faces. And it reminds one of Mr. Chidambaram when he returned to the Ministry of Finance, in the middle of 2012. Expectations back then were also very, very high that he's going to be able to do a lot of things. He's done a fair number of things, but the point is, and he's prevented. He's stabilized the currency. He's brought Dr. Raghuram Rajan back. The RBI has taken charge, and a lot of things have happened. A lot of good things. But the fact is, economic recovery takes time, right? And it'll have to run its own course, irrespective of how many things you do throw at this thing. Not that you should not attempt all these things, but are expectations running too high from a favorable political outcome?
Correct. In fact, that's a very interesting parallel you have drawn between 2012 when Chidambaram came back to the finance ministry and the expectations that we have today. And I think, there are very, very similar expectations. But I think, most people who are in this market are a lot more pragmatic. They do know that it's going to take another 1-2 years for the entire cycle to revive. If you look at how things are today, I think what gives us hope is the fact that we are already seeing signs of an improving macro. For example, growth has bottomed out, and expectations are that you would see a 5.5% growth as we go into 15, and maybe 6.5% as we go into 17.
No, so what you're saying then is that irrespective of whoever comes to power, right, after the elections, will inherit an economy where growth is actually already bottoming.
Exactly. So
4.7, 4.8%.
Therefore, I think it is not material as to who comes back into power, so long as it's a stable political formation. Because I think the choices between, for each one of them is exactly the same. They don't have very, very different choices, right? And we have a tough fiscal situation. We have a tough, inflation situation. But obviously, things are improving out there. Inflation, for example, if you look at CPI, I think you've seen CPI, cool down to something like 8.8%. If I look at the latest PMI numbers, clear indications are that CPI will drop to something like 8.5%. And I think by 14 end, if not 15 March, we will be at 8%. WPI has cooled down significantly to 5.5%. Will trending towards 5%. And with lower inflation, that gives you that much more room to go for some easing on the fiscal front and on the monetary front. And easing on the fiscal and the monetary front is good for the investment cycle. You'll see the investment cycle slowly reviving. But most important, I think, is that if you have a stable government formed at the center.
No, let's just stick with that. You said you referred to the PMI numbers, right? And
right.
So the first challenge seems to be growth inflation kind of trade-off, right?
Correct.
That's basically the point.
Right.
Higher growth at whatever pace it comes will stoke inflation. You refer to the manufacturing PMI number. Their detail shows that input prices actually rose quite a bit.
Correct.
Right, in the month of Feb. So that's really the first challenge for the new government going to be, because too much attention is focused on one, maybe growth, without adequate attention to the other variables which are also related.
Okay, this is interesting because you use this term growth inflation trade-off. I think sometimes I think it is important to realize that unless you have a sustained period of reasonably low inflation, growth is not going to come back.
Sure.
And therefore, it is important for us to tackle the inflation problem. Right? And I think the Reserve Bank of India is doing all the right things to tackle this. They have said that they will focus on CPI. They have said that they will have a reasonably tight monetary policy till they see inflation expectations coming down. And that's, I think, what they're keenly sort of focusing on, inflation expectations. And I do believe that as you see inflation coming down, there is a lot more scope to go in for an easy fiscal and easy monetary policy. And I think you're right. Unless we are able to drive ourselves towards easier fiscal and monetary policy, it will be difficult to get the investment cycle back and growth back. But I think if you look at how the macros are evolving, I think most things seem to be falling in place, and that's what gives me comfort. It's not a question of who comes to power and who doesn't come to power. It's a question of the fact that these improving macros and the fact that there are not too many choices that people have will sort of force most people into a path which will sort of lead the economy to recover. And that, I think, is good news, and markets are actually factoring that in. And you do see markets factoring that quite significantly. Coming back specifically to stocks, for example, if you look at the Sensex, now the Sensex ROEs have dropped to something like 16%, against its long-term average of around 18-19%. So clearly there is some stress in the system. Obviously, ROEs have dropped because the investment cycle has fallen, growth has fallen, consumer demand has fallen. There is an inability to pass on price increases, and that has impacted equity valuations. But this is the broad equity market. The markets are still polarized. If you look at some of the outsourcing stories, for example, you are seeing that pharmaceuticals and IT in the Sensex are quoting at 20 times 1 year forward. FMCG is quoting at 30 times forward. So obviously it's the cyclicals and the banking and the rest of the space that is pulling down evaluations. Even if you look at market cap to GDP, for example, at 60% market cap to GDP, it's lower than its long-term decadal average of something like 70%. So though the markets have moved up, if you look at broad valuations, they are reflecting the fact that there is a lot of scope for markets to sort of improve. And the first, I think, move will be when, sentiment improves, when people say that we are clearly on the path to do all these things in terms of bringing back growth, controlling inflation, going through the reform process. I think, markets will move ahead of, those expectations.
Yeah. Let's just put up some details about what Birla Sun Life Insurance actually holds in one of its biggest funds, right? So this is the Enhancer Fund, and I just want your thoughts on this. Just essentially portfolio leaning, and we've discussed about this earlier as well. This data is as on the 31st of January. So that the Enhancer Fund is gotten corpus of about 6,000 odd crores or so. That's the asset. I mean, the assets into which it is invested. Equity is about 27.5% or so. And let's get to stocks. Top holdings: Infosys, ITC, Reliance Industries, ICICI Bank, HDFC Bank. There is TCS. So There's HDFC Limited, there's Larsen, and then there is Bharti Airtel as well. So I just put out 9 or 10 of these, actually 9 odd names in terms of top ownership. How would you describe it? Leaning towards what?
Yeah,
I mean, actually, fair bit of financials, technology.
Right. So if you look at the portfolio construct, I think there is a bias towards the outsourcing story even today, and the portfolio is overweight on some of the outsourcing names, like names in the information technology space. And if you go down the portfolio, you will see some of the pharmaceutical names also, though valuations have run up quite significantly. The second sort of bias has been towards domestic consumption stocks that are sort of more or less immune to this slowdown that we are seeing, this what do you call it, political uncertainty, and you see some of the stocks over there. The third set of names which appear out there are some of the private banks, because if you look at private banks specifically, some of them in terms of their valuation are actually at a discount on a price to book basis to their long-term averages, and after a very long time we have seen them coming to a discount to their long-term averages. And therefore we do believe that as the cycle turns, as growth comes back, I mean, the banking sector will be the first to benefit significantly, and because the private banks have got significantly less stress on their books, given that the quality of lending is better and their risk processes are better, we do have exposure out there. Now, if you look at these cyclicals, for example, we do have some exposure to the energy sector, but we still haven't got very large exposure to the cyclicals, to the domestic consumption plays. And I think we will start looking at those once there is more certainty in terms of...
you can describe that as a domestic defensive.
Correct.
I don't know.
So those are basically the domestic consumer plays, which are defensive plays. You're right.
I see no pharma here, right?
No, so maybe the pharmaceuticals are not there in our top list. They're there very much in our portfolio, and we would have exited some pharma because of the valuations, because a lot of the valuations have moved up significantly. So we could have exited a little bit over there.
And do you expect to carry, I mean, the same basic portfolio construct going all the way into elections, and you don't expect to change this very significantly? Because there is one view which says that, and it's not a new view, frankly, that how much more of pharma and IT, right? The time for domestic cyclicals, right, which you own very few of. You own Larsen, for example, but the time for that in a big way is around the corner. You don't think that is true? So
maybe we won't increase exposure in a very big way to some of the outsourcing plays at this point of time, because as you rightly said, valuations are extremely high. As I told you, if you look at Sensex valuations, IT, pharma at 20 times 1 year forward, FMCG at 30 times 1 year forward. But we will continue with the existing portfolio construct till into the elections. And once there is greater clarity in terms of the election outcome, and we do believe that there is the time for the cyclicals to revive has happened. Till then, we would sort of be very cautious in getting back into domestic cyclicals.
You'd be very cautious. Okay, fair enough. I just want your focus on what people describe as plays on reforms, right? I mean, one area, of course, is the oil and gas space. You have Reliance there.
Right.
I mean, there is some controversy on the reform there, which is the gas price issue. I don't know if you've got specific thoughts on that, and then I want your thoughts on the oil marketing stocks. But first, RIL, which is one of the top three holdings.
So as far as gas pricing is concerned, as we get into a more market-driven mechanism, I think many of the gas producers are obviously going to benefit, and that is a space that we will look at very closely. In terms of the oil marketing companies, I think in terms of a path chosen by the previous government and the path that will be chosen by the new government, I think subsidies are clearly going to go. We are going to go into a regime where more and more of the fuel prices are market driven and the subsidies drop significantly, which will be a significant upside for oil marketing companies. And therefore, these are two spaces which we will look at very closely.
Do you have specific thoughts on IDFC? And I'm referring here to the banking licenses which will be announced soon. The stock is trading close to book value. Do you own it, and would you want to own more of it?
No, we own it, but in terms of specific thoughts, see, I have no idea as to what's going to happen on the banking licenses. I don't think any of us know.
No, but my point is, should IDFC, you've got many PSU banks which traded close to book, right? IDFC trades close to book. Should IDFC, after having gotten a banking license, deserve a premium compared to others which trade close to book right now?
Okay,
PSU
so
banks?
now if you if you're talking about the polarity, clearly the polarity is that the public owned, the state owned banks, they trade at a discount to their book. So they're normally at a price to book of 0.6 to 1, right? If you look at the privately owned banks, they all trade today at price to books of 2 to 4 times, right? Depending on the quality of bank. Now, I think whoever gets these banking licenses, the markets will actually take a call as to whether they will be able to run these banks, akin to how the private banks are running their businesses today, or will they run their banks akin to how the public banks are running their businesses today?
Sure.
And valuations will accordingly evolve. So I think it's a little early days to, to sort of guess as to whether if somebody gets a banking license, it will quote at, say, 2.5 times price to book or 0.6 times price to book.
Yeah, fair enough. Got that. Mr. Krishnan, thanks very much for dropping by, sir. Thanks as always, and it's a pleasure to hear your thoughts. Appreciate it. Let's take a break. We are back in 2.